Hi, welcome to today's video. Today's video is on the Petty Cash Fund and the Change Fund, two small funds that are very important in a business setting. So, let's start off with the Petty Cash Fund. What does the word petty mean to you? It means small, so we don't want to establish a petty cash fund for thousands of dollars lest it be stolen, right? So it's a small fund. What is it really used for? It's to purchase small items and you don't want to need to bother your boss. That's basically the purpose. So small items like coffee, the Girl Scout girl comes by and wants to sell cookies, the lawnman comes by, somebody's washing your car, things like this. So small things that you don't want to bother your boss with that so that you can keep the business going without disturbing him or her. To establish it, we debit petty cash and credit cash. So that sets up the petty cash as an asset account. We never, as I mentioned here, never debit or credit petty cash again except to make it larger or smaller. So if we were to debit petty cash or credit petty cash, we would be making it bigger or smaller, and that's not necessarily what we want to do. To reimburse petty cash at the end of the month, again, best done monthly, we debit the petty cash vouchers and credit cash. What are the vouchers? They are small pieces of paper with the details of the transaction on it. So for example, Mary went to buy coffee, and it's dated as to what day it was and the prices on there and all that type of stuff. Tom Hernandez came by to cut the lawn in front of our business, and maybe he charged $20, and so that's mentioned on there as to the day he paid him, cash, and that type of stuff. So everything is evidenced by a piece of paper as to who did what and when. So we debit the vouchers. By debiting the vouchers, we are getting rid of or canceling the vouchers. And by crediting cash, of course, the money is going back into the petty cash drawer. In this case, the petty cash drawer started at 100, would have ended at 20, and so now we're going back to the $100. Now let's just say that the vouchers were for office supplies, some miscellaneous type stuff, and maybe the Girl Scout girl. And so when I say debit the vouchers, it could be like for office supplies 30, miscellaneous expense 20, charity expense 30. Those are the vouchers. Those are what the vouchers totaled, and $80. And then the credit was to cash for 80. So these entries are normally recorded in a petty cash payments journal, which is basically a big spreadsheet. And they're approved every month, and we could go on from there, but I think this is enough to get you the idea of the purpose of a petty cash account and what you do. So remember, petty cash, small dollar amount. To record it, to establish it, you debit petty cash, credit cash. You never again debit petty cash or credit it except to make it bigger or smaller in terms of dollars. And the last one, you debit the vouchers, you credit cash. Okay, on to the change fund. What is the idea of a change fund? Well, it's a fund that's established to make change in a retail setting. So same idea as in petty cash. To establish it, we debit the change fund, and credit cash. Again, the same thing, never debit or credit again unless we want the fund to get bigger or smaller. So in this case, we're establishing $200 is what we want on hand to make change every day as people buy from us in our retail setting. At the end of the day, to reimburse, we look at our till. It has a certain dollar amount in cash. We always subtract the change fund because that money is always going to be in the till every day. So the difference between these two is the amount that is deposited. Again, this is done daily. We also compare that to the cash register tape for the day. That is the amount of sales for the day. The two could be different and likely are because sometimes we make change too much or we don't make enough. In this case, the cash for the day that was deposited was 800. The sales for the day was 801. So that created a cash shortage of $1. That goes to that shortage, in this case, goes to cash short and over. If it had been $799, then we would have been cash over by $1. That would have been credited as sales would have been $799. So 800 equals 800 in that case. Cash short and over is a temporary account that's closed at year end to miscellaneous expense or revenue. Generally speaking, it's going to have a debit balance, which means it's a miscellaneous expense. So we close it to the miscellaneous expense account at year end, and then we close the miscellaneous expense as well. To re-look at this example, the cash tape, again, was the sales. The till minus the change fund, till minus change fund is the cash deposit for the day. So again, you debit cash for the deposit for the day. You credit sales for the cash register tape. The difference then is your cash short and over. So don't try and make this too hard of a problem because it really is not. So there are similarities between the change fund and petty cash, although the purposes are different. I look forward to seeing you on the next video. Take care and have a good day.